Hello everyone, my name is Louis. Welcome to the channel. I hope you're having a wonderful day. The purpose of this channel is to share some useful information with you and hope this will give you some positive energy to enjoy your day. Now, today we're going to talk about investment risk. You need to understand all investments have risks. There is no such thing as risk-free investments. But if you know what to expect, then investment risks are no different than the risk of crossing the street. Yes, accident can still happen, but then it will become a calculated risk rather than unexpected risk. Yes, risk is a four-letter word that we all hate, but really don't understand. Sometimes the financial market can be more volatile than normal, and we took that volatility as risk. You need to understand the volatility of the market is not a risk. However, running out of money in retirement is a risk. The recent swing on Wall Street and the TSX has many investors and their advisors trying to adjust their portfolio to eliminate risk. And when that happens, they may be just switching from one type of risk to another. And quite often, they could end up increasing the risk instead of eliminating risk. Understanding different types of risks can help you to make educated decisions to protect your investments. We all know the financial markets go up and down, and different types of investments may perform differently throughout different cycles. A major downturn in the market can greatly reduce your investment assets. Therefore, your investment portfolios must be able to prevent you from a major loss during a market downturn. One way to reduce risk is to reduce your exposure in the stock market. Some advisors have been adding international or global markets to their clients' portfolio. It is supposed to diversify the portfolio from the dependence only on the North American markets. The downside to multi-countries investing is not only exposure to the currency exchange rate, it can also affect the portfolio in times of political instability, such as the case in Ukraine. Now, of course, currency hedging can reduce your currency risk, but it can also reduce your investment returns. I'm not really a fan of international or global markets. It's because most major companies in the TSX or the Wall Street are already doing business globally, so there is no reason for me to add any additional foreign risk into the portfolio. When investing, you need to make sure your investments are liquid and can be liquidated into cash in a short period of time. Investments such as real estate, thinly traded stocks, and bonds are all illiquid. However, the big name stocks, mutual funds, or exchange traded funds, they can all be converted into cash in a matter of 2 days. Fixed income type of investment is normally viewed as an insurance to balance the equity risk in a portfolio. Investors and their advisors have been mistaken bonds are safe. The reality is that even though fixed income investments can be less volatile most of the times, but sometimes they can be as volatile or even worse than equity. These days, we all know what inflation is when we see the gas price keep on going up. Inflation is when the price of goods today costs a lot more than what they used to cost. It hurts for fixed income investment more than stocks. Because to combat inflation, interest rate has to go up, and when that happens, bond prices will drop. When you're investing in bonds to balance your portfolio, you need to know bonds are like IOU type of investments. Therefore, there is always a risk that the issuers of the bonds may not be able to make their interest payment or may even in default at maturity. Seniors are often afraid to spend money because they are afraid of running out of money in retirement. Yes, if you withdraw too much money from your portfolio too early, you may exhaust your portfolio too soon. But on the other hand, if you're too conservative with your withdrawals, you could end up in heaven and your money is still sitting in the bank. Here's another investment risk that most people never even heard of. It's called the sequence of return risk. The sequence of return risk is if the return is low or negative before or even the first 5 years of your retirement, it can really impact how long your portfolio is going to last. There is nothing you can do to overcome sequence of return risk. It really depends on your luck. The health risk is another type of risk that you cannot control. A sudden, unexpected turn in health may exhaust your portfolio much sooner than you expected. And that is also another reason why seniors are not spending their money. Most investors are confused between the words risk tolerance and risk capacity. Risk tolerance is the degree of uncertainty that you can handle. However, risk capacity is the amount of risk or the amount of loss that you can absorb. A 20% loss may not sound a lot, but a 20% loss of $1 million portfolio is a $200,000 loss. I'm sure not too many people can afford that amount of loss. Therefore, you need to make sure the amount of loss that you can absorb before making any type of investments. As you can see, there are many types of risks that an investor can face. But the most important risk is the longevity risk. Yes, we all love to have that risk, but the longer you live, the more likely you are going to face more risks. To eliminate the longevity risk, you need a lifetime guaranteed income. Stock, bonds, and mutual funds will not work. You need some type of sustainable guaranteed income, such as annuity or guaranteed minimum withdrawal benefit from a segregated fund, to take the longevity risk off the table. Well, that's all for today. Thank you for joining us. I hope you found the information useful, and if you enjoyed this video, please give us a thumbs up and subscribe. Now, please note, all the information presented in this video is for general information and discussion purpose only, and should not be considered as legal, accounting, tax, or investment advice. You should always check with your own professional advisor before adopting any strategy here. Well, until the next time, please take good care of yourself, and I look forward to seeing you again soon. Goodbye.